Anytime corporate profits decline for 2 consecutive quarters on an economy-wide basis, over the next 12 months, the S&P has a peak-to-trough drawdown of 20% or more. And so again, we hit that second consecutive quarter in the fourth quarter of 2015 at down 11.5%. That decelerated from down 5.1%. Again, just looking at how Q1 earnings season is already starting to track, that's going to continue to decline. Again, so I don't know what you're buying. I mean, a lot, even, we've seen, 2 to 3 points of multiple expansion in the year to date. You're really off the lows, and a lot of it's been driven by, a lot of the price action has been driven by multiple expansion rather than, earnings recovery. A lot of people are talking about, well, the dollar's not going up as much anymore, so earnings are going to recover. But you continue to see earnings projections or earnings estimates trend down. You continue to see corporations cut guidance. So again, what do you? It's not what did you buy, because if you bought reflation or in early January and February, that was a hell of a trade. But it's what do you own now is the question we're making today, April 15th. And from here, are you buying more of that stuff? Are you holding it? Or are you selling it? And we're effectively giving you all the reasons that you need to be selling it.
With GDP edging towards 0% and company earnings looking disastrous, what are S&P bears missing?
Well, I think S&P bears missed a dramatic short squeeze. Hopefully people didn't ride it the whole way up. Hopefully there's some astute risk management there, along the way for our clients and our subscribers. But the point is, again, markets bounce, bear markets bounce. I think I sent this note to our top clients in maybe it might have been December of 2014. The note was titled bear markets bounce. We think we're going into a bear market. Don't freak out when the market rallies. We've had 3 material reflation rallies since then. I actually had a really long call with a long-time client yesterday, and he was talking to me about some of the other research providers he's using, and he cited a statistic that they showed is that the median return of bear market rallies is 16 or 17% historically. We're really just tracking along that. If you bought the stock market in 1932, or en route to another 50% decline, or even in October 08, that's the whole point of this exercise. It's bear markets are really hard. Bear markets don't really end until bulls and bears are losing money. It's hard to risk manage a bear market, and we're definitely not saying we're nailing it by any stretch of the imagination. But Keith did issue a bunch of cover signals in early February, and we're not going to shy away from taking credit for that. Now, do we maybe have shorted it a little bit too early? Of course, but again, we have a really negative view. We don't expect the bear markets to have. We didn't rather expect the markets to react as aggressively as they've had for the Fed effectively just taking down its dot plot. But it is what it is, and again, we're here April 14th or April 15th rather. What's the call from today? Leave the baggage at home, leave the emotional response at home, leave your P&L at home. Wake up today, turn your computer on, open your notebook, and figure out what you need to do today. What play do we need to call today? And the play we're calling today is deflation from here.